Hi there folks, welcome to the second part of the three-part video series on fundamental analysis. Now today we are going to look at the main market events and what they mean and how they impact the markets. So pretty interesting topic today. Before you watch the video, don't forget to subscribe to the channel if you don't already do so. Don't forget to hit that little notification so you'll be notified the moment the next video has been released. You can follow us on Instagram and Twitter, and of course if you follow us on Facebook you can tune in live every Monday afternoon 2 p.m. London time for a live event where we discuss market opportunities for the week ahead. Enjoy the video. Hi guys, now today I want to talk to you about the major events that come out in a calendar month that affect the currency markets and why we should care about them. Now before we delve deeper into that, let's talk about what the main driver is behind a currency valuation. Now the main drivers are basically interest rates. Interest rates come in all different forms, shapes and sizes. The one you may be more familiar with would be, say, the regular bank deposit. That's where you have money, you put it into a bank over a period of time, 2 years, 5 years, 10 years, whatever it is, and hopefully by the time you've withdrawn it, you've got a bit more money than you put in. That basically is the interest on your deposit. If you haven't got a deposit in a bank, you may have a credit card, in which case I'm pretty sure you know what interest payments are all about. That's when you pay them interest. The other form of interest that we talk about are the bond markets. Now, bond market or bond is basically an IOU. An IOU to a government, or it could be an IOU to a corporation, a company, or what have you. So basically you buy a bond, and that government will promise to pay you that money back in a certain period of time. But in the meantime, it will give you regular interest payments as well. Now, when you compare the regular interest payments to the price, you get what's known as a yield, a bond yield. Markets are always looking at the bond yields to see if bond yields are rising and if bond yields are falling. So why do interest rates really affect the currency? Well, a rising interest rate tends to lead to a stronger currency. And conversely, a falling interest rate would tend to lead to a weaker currency. Well, clearly, if you want to invest in a higher interest rate environment in a particular country, then you need to buy that currency in order to invest in that currency, in that country, in that bond or in that interest rate market. So if you buy a particular currency because you want to invest in that higher yield environment, then of course that currency goes up in value. Well, that's the theory anyway. And of course, if interest rates are falling, then you're likely to see a weaker currency as people move money out of that currency because they're not getting a return on holding it. That's basically why interest rates are so important when it comes to currency valuations. Now let's look at the role of the central bank. Every government around the world appoints central banks to basically control monetary policy. Now, central banks are mandated normally to do two things: to control inflation and full employment. One of the two, or sometimes both dual mandates. So inflation is key to what interest rates are basically likely to do, and the central bank controls those. Central banks around the world basically are looking at this all the time. In the US, we've got the Federal Open Market Committee, the FOMC. The ECB is the European Central Bank. You've got the MPC in the UK. You've got RBA, that's the Reserve Bank of Australia. Then you've got the Bank of Canada, the BOC. These are the major 8 currencies that we trade in the forex market, but of course every country has a central bank as well. Bank of Japan there, RBNZ, the Swiss National Bank as well. So these are regularly watching what's going on in the economy and deciding what is going on. Remember, most of them have this mandate to control inflation. They want to keep inflation at a predetermined level, normally set around 2%. So they're looking at all this information that's coming out of the financial markets to decide what they should do with interest rates to control these two mandates. So what data are they looking at? Well, basically they're looking at a whole bunch of economic releases that are released periodically throughout the calendar month. So first up, we've got unemployment. Unemployment is the most important data release in the calendar month. Now in the USA, this is called non-farm payroll, or NFP. Comes out on the first Friday of every month, apart from over holiday periods and so forth. So it's a keenly awaited data release. It is the main data release in the calendar month. You've often heard that expression in the past: when the USA sneezes, the whole world catches a cold, because the USA is the biggest economy in the world, and of course everyone's looking to see what's going on there to get a gauge of what's going on the global economy. But so why is unemployment important? Well, clearly, remember, central banks are mandated to control inflation. Now, if unemployment is falling and more people have jobs, that means more people have money in their pocket. And if more people have money in their pocket, what are they doing? They're out spending more money on goods and services. If they're spending more money, then of course prices go up. Prices going up, that means inflation's going up. And remember, central banks have to control inflation, usually around 2%. They may have to move interest rates higher. Moving interest rates higher means the currency goes up. So unemployment is the main release that comes out on the calendar month. That coupled with average earnings, basically telling you are people earning more money this month than they did last month. If they're earning more money than they did last month, then of course they're spending more money. And if they're spending more money, yeah, you guessed it, prices go up, inflation goes up, interest rates may have to go up as well because they have to control that around 2%. Those are the two major economic releases that come out in the calendar month. Now these are lagging indicators. Lagging indicators basically means they're looking back at last month's data. There are also forward-looking indicators, which we'll talk about in a moment. But you've got lagging and forward-looking. These are lagging indicators, as is retail sales. Retail sales basically tells you how much money is being spent on the high street or online or what have you. If more people are spending money and retail sales are going up, then of course that is inflationary and central banks will need to react. So retail sales, we always look at retail sales. CPI actually is the inflation number. It stands for Consumer Price Index, tells you what prices are actually doing. You also have revisions to these as well when more data comes in from previous months. But the CPI is the inflation number. Producer price index as well, that's basically telling us what the producers are paying for their raw materials, and of course if that's increasing they've got to put that through to the consumer, so consumer prices are likely to go up as well because the producer prices are going up. So that's an early sign that inflation may be getting into an economy, the producer prices. Now we've got the forward-looking indicator. This is Purchasing Managers Index, known as the PMI. It's basically a survey of 400 to 500 business leaders in different sectors, manufacturing, services and so forth, basically looking for their outlook of the economy going forward. Are they employing more staff? Are they investing more in machinery and plant and so forth? Of course, if they're optimistic about the economy, that's what they would be doing. And this is an early sign of an economy that's looking to grow. And a growing economy means inflation. Of course, the governments need to react. So these are early signs that the central banks really like to look at in terms of their interest rate policy. The Purchasing Managers Index. Keep an eye on that one. Durable goods, that's basically the white goods, your tumble dryers, your washing machines, things that you don't buy on a weekly basis, but you sort of buy them every 2, 3, 4, 5 years or something like that. Clearly, if you're concerned about your job or you think you're going to be laid off, then you don't start investing and buying all these white goods, durable goods. If you're confident about your outlook and your job and the economy going forward, then you might start looking to change that durable good that you do every 3 or 4 years. So those durable goods, again, it is a lagging indicator, but it's an indicator of what basically is happening to you and I, the consumer. Then you've got industrial production, basically how much industry is producing as well. It's a lagging indicator. It shows you how the state of the economy is looking. Okay, and then you've got the trade balance. Trade balance is basically the difference between what a country is importing to what it's exporting. Is quite unique to a particular country, not as inflationary as the other indicators there, but certainly tells you how an economy is doing in comparison to another economy as well. So we look at trade balance, not as important as it used to be in the past, but certainly one we look at as well. Then you've got the gross domestic product. That basically tells you the health of a country, basically tells you how much money it's got almost. It's like yourselves and your own bank account. As you see your bank account grow, you're getting wealthier, same as the GDP for a country. Basically tells you if the country is getting wealthier or not. So then you've got the housing data. Housing data is important data. There's various shapes and forms of housing data. You've got the housing starts, mortgage approvals, new home sales. Of course, if you're confident about the economy and the economy is booming, more houses are being built, people are buying more houses and so forth. So we always look to see the housing data. It gives us a general view of what the state of the economy is doing. So all these data releases, you bunch these all together, you're getting a picture of how the economy is doing and basically where interest rates may go. Commodity price index. This is basically the price of commodities. Certain countries like Australia, Canada, these are commodity-based currencies, so basically, iron ore, copper, and so forth. Now, all these prices are going up, then of course that's good for the countries that produce them, such as Australia. So, commodity price index is keenly watched by those particular countries as well. And indeed, it also shows you the state of the global economy. If commodity prices are going up globally, then that shows you that there's inflationary pressures in the global economy as well. So we always look for consumer commodity price index. Oil inventories, basically how much oil is above the ground in storage, certainly affects certain countries. In particular, would affect Canada, Canada being one of the big oil producers out there. And of course, if oil inventories are building up, that basically means there's a lot of oil in storage. It means basically there's increased supply. Increased supply doesn't help prices, so oil inventories increasing means prices will go down, and prices go down in oil may affect the Canadian dollar and so forth, other oil producing countries. But also the oil inventories is an indication of, again, the global economy. Is the global economy growing? If it is, then obviously more oil is needed. So oil inventory is another important one there. And personal income and personal spending, I think they stand they're pretty obvious what they are. It's basically what income is, and takes into all the accounts all the different parts of an income, and spending as well. Now there are other fundamental drivers as well that are not necessarily economic releases that come out on a periodic basis, so we need to talk about those briefly as well. First, you've got the interest rate decisions and statements. So as I said, these central banks, these move interest rates, or they review interest rates on a monthly basis. They all get together for about 2 days, and then they decide what's going on with interest rates, whether they cut interest rates, increase interest rates. And even if they're not moving interest rates, the follow-on statement is often very important as well, or the press conference that comes as well, because it gives an outlook of what the central bankers are thinking. They may leave interest rates unchanged, but they put out a projection of what's going on in the future. In the US, this is known as the dot plot. The governors all basically put out on literally a plotting out where the interest rates will go in the future. So the market's always looking at the interest rate decisions and statements from the central banks, and these are big keenly awaited data releases. Central bank speakers. Central banks love speaking. It's all part of the forward guidance policy. You always see them on the news wires, on the news channels, talking, being interviewed, giving an outlook of what they think is going on in the economy and so forth. So the markets are always looking at that. They are on the calendar, the economic calendars, so we do pay attention when we see central banks speaking or giving testimony and so forth. And Trump tweets. Trump loves a tweet. I mean, since he was elected back in 2016, he's been fastest fingers first on that tweet, and it does affect the markets. He says things that moves markets. Anyone can get a Twitter account and see exactly what he's up to. You're just as fast as any big institutional investor if you've got a link to Trump's Twitter feed. He does say things that does indeed move the markets as well. Then you've got the G20 meetings. This is where all the leaders of the developed world get together and they discuss everything from economic policy, climate change and so forth. Sometimes policy announcements made, sometimes outlook is, the economic outlook is discussed as well. And so we always look at G20 meetings. Sometimes something important comes out. Not so important these days, but we certainly pay attention to it. International trade disputes and agreements, of course. We're always looking at that at the moment. Obviously hot in the news. With the USA and China talking about trade deals. Of course, a trade deal is good for the economy, presumably. A non-trade deal is bad for the economy. So we're always looking at that as well to see if any trade agreements or disputes are arising, because it does give you a picture of what's going forward in the economy. So know your calendar. So now, with all that in mind, it's important to know the calendar, know when these economic releases are coming out. Now, in the next lesson, we're going to look at where you can find these economic releases, the projections and the schedule, and also how to interpret these releases. So I'll see you in the next lesson. Okay, so I hope you enjoyed that video. Give me a thumbs up if you did. Give me a thumbs down if you didn't. Don't forget to leave a comment as well. I get back to all of them in due course. Don't forget to follow us on Instagram and of course on Twitter. If you follow us on Facebook, as you know, you can tune in live every Monday afternoon, 2 p.m. London time, for a live event where we discuss trading opportunities for the week ahead. Okay, so that's 2 done, 1 to come. Part 3 next week. See you there.